Warren Buffett claims that an investor who put away $10,000 in an index fund or ETF in 1942 would now have almost $51 million. And some say the only way to make money in the stock market is through index funds and ETFs, and any other strategy is based on luck or manipulation. But is that the truth or just a deception to get regular people to put money into the economy? Currently, the market is taking a serious hit, so let's see whether or not index funds and ETFs are as potent as some economists claim they are. And if they're right, let's see which indices and funds are best for you. Hi everyone, it's Jules. In this video, let's take a look at where you can invest your money this 2022. But before that, don't forget to smash the like button below and subscribe to Investing Wise Academy. If you want to get rich during a recession, you need to know which industries have the best potential. And now, we're going to discuss a genuine index fund and ETF approach in addition to the top 5 funds you can invest in. Now when it comes to investing, you got 2 problems. Number 1 is timing. Timing is the factor. Knowing when to purchase and sell is essential, and contrarian investing is one approach developed to address this issue. It is reported that Nathaniel D. Rothschild once stated, "But when there's blood in the streets," which is a horrific expression that means most investors let their emotion get the best of them. The markets are pretty volatile right now. It's unsettling since we have no idea what will happen next, and the general public has given up on investing entirely. The decline in the S&P 500 index is occurring 3 times as quickly as did during the dot-com bubble. So, this means we can once again trust the contrarian approach? Buffett says, yes. You probably read the proverb that goes something like, "Be greedy when others are scared and be fearful when others are greedy." Buffett can confirm that. In one of the most worst stock market disasters ever occurred between 1973 and 1974. This is when inflation hit double digits, the economy tanked, and there was a conflict in the Middle East. However, it was a catastrophe, with the market dropping 46% in just over 2 years. And amid all that jolly old conflict, they spotted their chance and smashed a stake in the Washington Post. After storing it for a while, he decided to sell it for nearly 100 times its original price. There's no magic formula for achievement, but examples such as this highlight the importance of doing your homework. This tactic isn't about stocking up when things go on sale. Instead, it involves doing the legwork to identify which firms or industries are trading at discounts to their true value. Number 2. Choosing what to buy. This is when index funds and ETFs comes in handy. Now, some people hear index funds and their minds conjure images of a bad marriage, a long-term commitment with low returns and a lack of exciting opportunities. However, the reality is that more activity isn't necessarily better. You can think of an index fund as a basket of stocks. It's a portfolio that mirrors the gains or losses of a single category of holdings. In other words, they did what everyone else did instead of trying to outsmart the market. Never mind trying to find the needle in the haystack. Just purchase the haystack, as Jack Bogle once advised. There are a few aspects to focus on when comparing an index fund with an exchange-traded fund or ETF. First, which market or sector is that research focusing on specifically? That's the scale at which you're looking to invest. Emerging markets and booming companies might be all candidates for the S&P 500. The fees are the second part of the equation. That's how much of your money will be used to pay the manager's salary and other expenses. To be sure, it's true that picking funds with low expenditure ratios is almost the way to go, and that ranges from almost nothing to about 0.4%. The minimum investment is the third consideration. Many modern funds require no minimum investments and allow customers to get started with just a few cents. You'll need a few $1,000s or more to participate in other funds. Now, are you still with me? Great! I want you to think about trying our super thanks, wherein your comments will be highlighted, or you could join our membership program. And now, let's talk about the markets in which you can invest your money in. Number 1. Renewable energy. We are currently on track to permanently end our reliance on fossil fuels. In fact, petrol cars will no longer be sold in the United States or Europe after 2035. The difficulty is that this trend will spread to many sectors. Wind power, solar power, hydrogen power, and electric power are all competing technologies in the green industry, and it's difficult to predict which one will come out on top. That's why I recommend a diversified fund like iShares Global Clean Energy ETF. It invests in a broad range of renewable energy companies and has low expense ratio of 0.42%. There's a second choice, and it's an excellent one, but its name is ridiculously long. It's called the First Trust Nasdaq Clean Edge Green Energy Index Fund. Number 2. Healthcare. There are a lot of factors driving change in this market, and with each shift comes a new opportunity to cash in. The general life expectancy is rising and is not likely to reverse course. Last year, healthcare IPOs raised a record-breaking $17 billion, thanks in large part to the attention brought to the industry by the pandemic. Biotechnology, medical supplies, and medical insurance are also included. Health is like betting on black and red simultaneously, with the global population reaching 8 billion. The Healthcare Select Sector SPDR Fund is one possible vehicle for such investment. Johnson & Johnson, Pfizer, and United Health Group are just a few of the S&P 500 members. Also, the expense ratio of 0.1% is very attractive. Number 3. Electric vehicles and semiconductors. Our society is currently experiencing a technological revolution, and every business is, in essence, evolving into a tech firm. Semiconductors are the connecting technology for the autonomous vehicles, 5G networks, artificial intelligence rockets, robot girlfriends, and cutting-edge computers. The world's most cutting-edge enterprises rely on chips from chip manufacturers. Now, the current shortfall has convinced policymakers that we need more and more of these chips. Therefore, the VanEck Semiconductor UICITS ETF is a possible investment. These funds allow 25 of the world's leading semiconductor manufacturers. And although it has a lower expense ratio of 0.35%, this investing strategy is often riskier than others. That's due to the political friction between China and the US and the chip shortage. Conversely, McKinsey predicts that by 2030, the industry will be worth $1 trillion. Number 4. Large caps. The biggest fish to catch while investing here are Amazon, Coke, and Microsoft. Unfortunately, there is a catch. Large cap technology recently took a bigger legal hit than Amber Heard. Thus, I will present you with a choice between two alternatives. The Vanguard Value ETF is one example. It is a pretty diversified across technology, healthcare, and energy, concentrating on firms trading at discounts to their underlying values. The other one is highly dynamic Vanguard Growth ETF. Investing in technology at 50% weighting is risky, but the strategy adores successful businesses. Number 5. The S&P 500. It's basically the economy of the United States of America, which is why it's so difficult to compete with. You either choose the Schwab or Vanguard S&P 500 index funds. Both are reliable and cost-effective. The key question now is whether index funds truly produce high returns or whether this is a ruse that investors should be wary about. Once again, Jack Bogle, the iconic creator of the Vanguard Group, says that everyone hopes to strike it big by the early on investing in a company like Apple or Google, enjoy spectacular returns, and retire in the remote islands of Southeast Asia. Though he's correct, he argues that you shouldn't put all your eggs in one stock's basket. However, you can own the entire stock market by simply following an index. So, which of these index funds and ETFs are you thinking about right now? Make sure to let me know in the comment section below. And while you're at it, make sure to smash the like and subscribe buttons as well. Now, if you're still wondering what ETFs are, then make sure to watch this video and learn more about it. And that's it guys, thanks for watching and see you next time.